Hello, everyone. This is Ted Bauman here, editor of the Bauman Letter from Banyan Hill Publishing. My guest today is Jim Rickards. We at Banyan Hill have a lot of respect for Jim. He's a colleague, and we pay close attention to what he has to say. He's a former advisor to the CIA and helped the Nixon administration craft the petrodollar accord, obviously big in the news today. Without Jim's help, the 1998 long-term capital management bailout, many believe that the Russian debt default in that year would have triggered catastrophic events for the global financial system, and yet Jim helped them through it. Jim, welcome. How are you doing?
I'm fine, Ted. Great to be with you. Thanks.
It's great. Now, you're here today to tell us about a frightening economic theory, which was first developed in the 1970s by one of the market's greatest forecasters and a pioneering technical analysis, Edson Gould. Tell us about it.
Sure. There's sort of an idea that's propagated in academia that markets are efficient. They instantly incorporate all available information. They move smoothly from one level to another. And basically, you can't beat the market. You can't forecast the market because it's this aggregate of information. Everyone has the same information, and you just can't do it. And the only way to invest is go into an index fund and just kind of ride the wave. Everything I just said is false. That is what they teach you. That is what academia says, but none of it is true. First of all, markets are not efficient. You just have to look at October 19th, 1987, when the stock market fell 22% in one day. Tell me what's efficient about that. It's been analyzed. We know what happened, but nothing efficient about it. But that's true through, ask yourself, take the Federal Reserve, for example. Did they see long-term capital management coming? No. Did they see the dot-com meltdown coming in 2000? No. Did they see the 2008, global financial crisis because of mortgages? No. Did they see the 30% drop in the stock market in March of 2020? No. They never see it coming, and neither does the market, obviously, or it would have adjusted. Right. So the question is, so markets are not efficient. And they do move on certain things, but can you identify them? Can you find them and look at them in such a way that you can actually predict the market? The answer is yes. Now you need the right models. Unfortunately, a lot of the forecasters use badly flawed models with what are called closed form equations with a lot of difficulty. But if you can get the right factors and build the right model, you can consistently get ahead of the markets and in effect beat the market in terms of total return. Edson Gould found one of these. It's one that I've looked at from other perspectives, but when I saw how he had quantified it, it makes it, if you know it, it makes it much easier to spot, much easier to work with. And it basically has to do with the Federal Reserve raising interest rates. My starting place in a lot of the models I build is the Fed is always wrong. Now, they're not wrong 100% of the time, but they're probably wrong about 95% of the time. So if you know they're wrong, if you know they're going to mess up the economy, and you also know what to look for, which is one of the things that's Gould identified, then just look for it and act accordingly. So we have a very powerful indicator, very good track record. It is the case that you can predict markets if you know what these factors are, and that's what we're doing.
So now you're saying that you could predict to pretty much the exact date when some particular event in the market is going to occur based on what this model says, this will trigger it?
Yeah, the answer is yes. And you say, well, how do you know the exact date is going to happen? There's certain things you see this happening, go, okay, that is a good indicator of trouble ahead. And there are things like that in like inverted yield curves and Eurodollar futures curves and all that. But this is one where, why do we know the exact date? How could we possibly know? Well, the answer is it's the Fed's calendar is published 2 years in advance. So right. if what you're looking for is the Fed is going to do something that's going to trigger a market collapse, well, two things. Number one, what the dates of the Fed meeting are. They have 8 meetings a year. They can have an emergency meeting if they want to. That's rare. It happened a couple of times after long-term capital management in 1998. It happened during the pandemic meltdown, pandemic panic in 2020, but it's rare. So they meet 8 times a year, not quite once a month, about every 6 weeks. They publish the calendar in advance. We know when they're going to meet. And they pride themselves on what they call transparency, which is they tell you what they're going to do. I just tell people, just listen to the Fed and believe them. Yeah. It doesn't mean they're right. They usually get it wrong, but they do tell you what they're going to do. So the Fed has signaled they're going to raise interest rates at the meeting on March 16th. So we know the date. We know what they're going to do. And we know the indicator, which is that if they raise interest rates a certain number of times, the market's going to fall out of bed. So we know all these things. So we just have to act accordingly.
So what does this mean for our viewers? I mean, how does it affect them? How can Main Street investors prepare themselves for what you think's coming?
Well, if you know the stock market's going to go down, which we pretty much do based on what we just discussed,
Right.
then all you have to do is have the right trading strategy. I just talked about modeling and forecasting, and that's difficult, but we just talked about one of the ways to do it. So you just need the right trading strategy. Now, here's where our service comes in. Here's where it gets a little more challenging. You can just short the whole market. You can use an index fund or an ETF or something like that. Yeah, but on certain days, it's going to go up. But nothing goes down in a straight line. Nothing goes up in a straight line. There's a lot of volatility in the market, and so you don't want to be on the wrong side of it. Even if you've got the trend right, you can, the old saying, you can lose money longer than the markets can be irrational. And so you don't want to fall into that trap. But if you look at particular stocks, now here there's another model that we use. So, okay, we know the trend's going to go down. We know the Fed's going to mess up the economy. They're going to raise rates and they're going to send the stock market down. That much we know. So then the question is, which individual stocks can investors pick? There are two benefits to that. Number one, a higher probability of getting the trade right, because we're looking at particularly weak stocks using a different model. This is not the Edson Gould model. This is a different model that we use in the service. So that's one. But number two, there are trading strategies where you can have leverage, but at the same time limit your losses. And we get a lot of them right. We don't get 100% right. We never said that. But when you get it wrong, you want to make sure that the loss is limited. You don't have, what you like is a trade where you can have kind of potentially unlimited profits, but limited losses. And there are ways to do that. And we explain those to readers. So by looking at individual stocks using certain indicators, and furthermore, using a particular trading strategy that boosts your gains, but limits your losses, that's the way to make the most of it.
Well, Jim, that sounds fascinating. And I mean, I think, you've sketched out an entirely plausible course of events and a way for people to protect themselves from it, possibly even profit from it. So you got a new service coming out, and I'm sure most of our viewers will love to find out about it. It's going to be informational, being closed in the email that accompanies this video. Jim, thanks very much for coming on. I wish you best of luck with your new service.
Thank you, Ted.
Thank you.